Today on Boot Bentz, the only show dedicated to finding Cliff Bentz a new job. I think it's more than appropriate that the second item listed on the inside of Bentz's little mailer here mentions tips. By now, the food delivery heard round the world has highlighted the regime's proud achievement in cutting taxes for the gigging to pay medical bills economy. This is part of the Big Beautiful Bill's tax relief extensions. A Bentz would prefer that you call it the Working Families Tax Cut. It's still just H.R. 1. The literature says H.R. 1 extends the 2017 tax cuts to prevent a 22% tax hike and introduces new deductions for tips, overtime pay, Social Security benefits, and U.S.-made vehicles. I have previously called out the permanent tax provisions in H.R. 1 for their outsized benefits to the wealthy and to corporations. Corporations that seem to avoid paying taxes by and large, but if they so choose, the new 21% corporate tax rate is an option. So instead of digging through those unfriendly numbers, let's focus on the 4 examples Cliff has listed here, presumably because he's proud of them. First off, much has been made of the new tax deductions on tips, even its misleading name, No Tax on Tips. Despite being a popular campaign promise, it was initially excluded in the main body of H.R. 1, so it was added as a separate bill. What is the impact of this deduction? Well, according to the Economic Policy Institute, it will expand the prevalence of tipped work. More workers awkwardly asking for tips where they didn't used to and shouldn't have to. And employers will now use these tips as a pretext for limiting pay increases. When states experiment with this, it represents major lost local and state revenue through tax avoidance, especially for high earners. It's also important to note that just under half of all American workers earn $25 per hour or less, and only 5% of them work in industries with a tradition of tipping. What's more, the Brookings Institute has pointed out that 37% of tipped workers already pay no income tax. To be more precise, they don't earn enough to require paying taxes. There may also be cases where unreported income from tips precludes certain earners from taking advantage of the Earned Income Tax Credit or the Child Tax Credit. The tech overlords of the gig-based economy have already made it clear that they'd rather not have to abide by pay standards or endure a challenge to the legality of not being considered an employer. Not reporting taxes on tips further entrenches this Wild West approach to employment. Federal law dictates that if an employee earns more than $30 a month in tips, they can be paid as little as $2.13 in their hourly wage. If tipping is expanded to include more retail and food service workers, the reach of this low hourly wage will spread with commensurate speed. Even then, employees will have to watch out for themselves when it comes to tip-based wage theft. Tipped income also won't be counted when determining the amount of unemployment benefits given out to applicants. Well, let's move on to the Social Security deduction. Once referred to as no tax on Social Security, this part of H.R. 1 actually just adds a deduction for Social Security recipients ages 65 years and older. While technically this will impact almost 90% of recipients, it will mostly benefit high-income earners who are able to leverage professional tax advice to maximize the usefulness of this deduction. None of that is necessarily bad, but it's not a complete and permanent repeal of the tax on Social Security benefits. In fact, this new deduction is temporary, as are all 4 of the tax cuts being touted here. All 4 will need to be renewed in 2028. That should beg the question, how are people on Social Security supposed to financially plan ahead when this new deduction might not make the cut in 2 years' time? If this helps seniors, shouldn't it help them beyond 2028? Even then, with the Social Security tax cap preventing greater taxation on higher income earners, this trust fund millions of Americans rely on now, and soon, may very well die by 2030. On to the third item. No tax on overtime. Again, this is just a new deduction for hourly workers. By the way, the average wage among hourly private sector workers stands at roughly $37 an hour. Excluding supervisors and focusing on production roles, the average becomes $32 an hour. Hourly workers earn between $66,000 and $77,000 per year, according to the Federal Reserve. The average cost of living in America shakes out to about $75,000 annually. However, these averages leave out the fact that 1/3 of America's hourly workforce earns $20 or less per hour. In no part of this country is that enough to live on. So a tax break on overtime has to be a good thing, even if it must be fought for again in 2028. The deduction is up to $12,500 for individuals and $25,000 for joint filers. And what a lovely image. Both heads of the household away from home, working in excess of 80 hours a week. Minus daycare, medical insurance, and other rising costs, the emphasis is clearly on working and not family. Again, on behalf of these hardworking Americans, why is this tax provision temporary? If it really helps, will it stop helping in 2028? Will workers become less worthy of it? Or is this some kind of risky gamble that needs to be closely monitored for potential negative impact, unlike cutting $1.4 trillion in taxes for 1% of us? Perhaps the US-made cars deduction will help. This provision allows purchasers of new American-made vehicles to deduct up to $10,000 in auto loan payments from their taxes. If the vehicle was sold after late 2024, weighs less than 14,000 pounds gross, and was purchased with a personal secured loan, borrowers could write off as much as $30,000 between 2025 and 2028. So, who's buying new vehicles? About 25% of consumers. The remaining 75% consider a new car out of their reach. It makes sense when 90% of households are struggling to make their monthly budget work as it is. The American auto industry has sold 1 million fewer vehicles this year over last year. Car prices have increased by 4%. In that same space of time. The average new vehicle sale comes to about $50,000. The market is shrinking and starting to favor more premium offerings. The US dollar, which typically buys many US cars, has lost 10% of its value since the start of 2025. A poll by Edmunds in the fourth quarter of 2025 shows that only 1 in 5 Americans would commit to car payments totaling $1,000 or more. And just because they can justify buying a new car doesn't mean they can justify paying back the loan. Cars are negative equity. They depreciate, and sometimes the loan terms can mean that the loan amount may exceed the value of the car pretty quickly. The car is now underwater and not in the James Bond sense. 90-plus day auto loan delinquencies hit a 15-year high in 2025. Subprime auto loan delinquency is at 6%, the highest since 1994. Average monthly payments are now at $600 due to interest rates, car prices, and inflation rising at the same time. 7% of Americans are facing repossession of their vehicle. America's auto loan debt now exceeds $1.6 trillion. Enjoy your auto loan deduction while you can, and if you dare. Cliff Bentz is hopeful that these scraps, too spoiled to provide sustained nourishment, will suffice when it comes to succoring the working families his tax cuts claim to relieve. At least that is until 2028, when the excesses and miscalculations of H.R. 1 are blamed on these provisions, and they are summarily excluded from renewal. These provisions are merely future scapegoats for the big, bad bungling of America's tax code. Trillions in tax cuts for 10% of Americans made permanent, while they drop this pittance for the workers they exploit.